Welcome everyone. I am pleased to have you here for this comprehensive overview of the building blocks of risk management, which is the first chapter of the book one called Foundations of Risk Management. This is a foundational reading, and I mean that quite literally. Most FRM learners and enthusiasts, especially those with risk management background, often take this part of chapter for granted and skip diving deeper in. But that's a mistake. Everything you learn later in your FRM journey builds upon these concepts, whether you are preparing for the next exam or simply looking to strengthen your understanding of financial risk. This session will provide you with the essential knowledge you need. We will explore fundamental concepts that form the foundation of modern risk management practices. By the end of this presentation, you will understand not just what risk is, but how to identify, measure, and manage it effectively. So let's dive in. Before we get into the content, let me outline what we will accomplish today. These learning objectives are taken directly from the FRM-GARP curriculum, so pay close attention. These are exactly what you need to master for the exam. First, we will explain the concept of risk and compare risk management with risk-taking. This distinction is crucial because financial institutions do both simultaneously. Second, we will evaluate, compare, and apply tools and procedures to measure and manage risk. This includes both quantitative measures like value at risk and, of course, qualitative techniques. Third, we will distinguish between expected versus unexpected loss with practical examples. This concept is fundamental to understanding economic capital requirements. Fourth, we will interpret the risk-return relationship and explain how conflicts of interest can impact risk management. Understanding these dynamics is critical for real-world application. Fifth, we will describe and differentiate between different classes of risk, such as market risk, credit risk, liquidity risk, operational, and many more, and explain how each type can arise and impact an organization such as a bank. Finally, we will explain how risk factors interact with each other and discuss the challenges in aggregating risk exposures across an institution. These objectives map directly to exam questions, so as we go through, think about how concepts like link to each other and interact. So let's start with the most fundamental question. What is risk? In a financial context, risk is the uncertainty regarding future outcomes that may negatively impact an organization's objectives. Notice I said uncertainty. Risk is fundamentally about not knowing what will happen next. Risk manifests in several ways. First, it is a potential for financial loss or adverse outcomes. When you make an investment or extend a loan as a bank, there is always a chance things will not go as planned. Second, risk represents variability in expected returns or results. Even if your expected return is positive, the actual outcome might deviate significantly from that expectation. Third, risk involves exposure to uncertain economic conditions, things like interest rate movements, exchange rate fluctuations, macroeconomic shocks, or geopolitical tensions. Here is the key principle that is critical to understand. Risk must be identified, measured, and managed. You cannot manage what you cannot measure, and you cannot measure what you have not identified. And remember these fundamental principles shown here. Higher risk typically comes with higher potential return. This risk-return trade-off is the cornerstone of finance. Investors demand compensation for bearing risk. If a corporate bond and a government bond offer the same yield, everyone would buy the government bond because it is safer and risk-free. The corporate bond must offer a higher yield to attract investors, and that is called the risk premium. Now, this is an important distinction that many people miss: risk versus uncertainty. This goes back to the economist Frank Knight's work from the year 1920s. Risk has measurable probabilities and consists of two components: the probability of an event occurring and the magnitude of its consequences. For example, we can estimate the probability that a borrower with a specific credit rating will default, say 2%, and we can estimate how much we would lose if they did really default. That's risk, and we can quantify it. Uncertainty, on the other hand, involves situations where probabilities are unmeasurable. These are the so-called unknown unknowns, events we cannot even imagine or assign probabilities to. Think about in this way. Before 2008, could we have actually modeled the probability of a simultaneous collapse in housing prices across multiple US states, combined with a freeze in interbank lending markets and a failure of major investment banks? That was uncertainty, something outside our probability models. For the exam, remember, risk is quantifiable, uncertainty is not. Risk management deals primarily with measurable risk, but we must also acknowledge that uncertainty exists and build resilience against it through stress testing and scenario analysis. Here is another critical distinction: risk management versus risk taking. Risk management is about reducing uncertainty and controlling exposure. It's defensive. You are trying to understand your risks, measure them accurately, set appropriate limits, and ensure exposures don't threaten the organization's viability. Risk-taking, in contrast, means you accept uncertainty in pursuit of profit. This is offensive. Banks take credit risk when they make loans because they earn interest. Trading desks take market risk because they profit from price movements. Insurance companies, for example, take underwriting risk because they collect premiums. Here is the crucial insight, and this appears frequently on the exam too. Financial institutions do both simultaneously. A bank doesn't just manage risk or just take risk, it does both. The art is in taking the right risk while managing them appropriately. Think about a commercial bank. It takes a credit risk by lending, but it manages that risk through credit analysis, diversification, collateral requirements, and loan loss provisions. It takes interest rate risk through maturity transformation, but it manages that risk through asset liability management and hedging. The goal isn't to eliminate risk. It is to take calculated risks that are properly compensated while avoiding risks that could be catastrophic to the bank or to the organization. Risk management organizes risk into two broad categories: financial risks and non-financial risks. Financial risks include market, credit, and liquidity risks. These are the traditional risks that banks and financial institutions have managed for centuries. They are quantifiable, often modeled mathematically, and we have sophisticated tools to manage them. Non-financial risks include operational risk, strategic risk, and compliance risk. These have gained enormous prominence over the past 2 decades, especially after events like the 2008 financial crisis, and more recently with cyber attacks and regulatory penalties. It's important to understand that while we separate these for analytical purposes, in reality they interact and amplify each other. An operational failure can trigger liquidity problems, a compliance violation can damage reputation and cause credit issues. In the next several slides, we will explore each of these risk types in detail. Pay attention to how they are defined, how they arise, and how they are measured. All exam testable materials. Let's dive into the first major financial risk type, market risk. Market risk is defined as the risk of losses due to changes in market prices and rates. It is one of the most visible and actively managed risks in financial institutions. Every day, traders and risk managers watch market movements closely. Market risk has 4 primary components. First is equity risk, the risk of losses from stock price fluctuations. If you hold a portfolio of stock or equity derivatives, adverse movements in equity markets can erode your portfolio value. For example, during the 2008 crisis, the S&P 500 fell by nearly 50%. And institutions with equity exposure suffered significant market risk losses. Second is interest rate risk, which affects bond prices. This is crucial to remember that bond prices and interest rates move inversely. When interest rates rise, bond price fall, creating losses for bondholders. Banks with large bond portfolios are especially exposed to this risk. In 2022, when central banks around the world rapidly increased rates to fight inflation, bond investors experienced one of their worst years on record. Third is currency risk or foreign exchange risk. This arises from movements in exchange rates and affects an institution with cross-currency exposures or foreign currency positions. Imagine you are a European company with USD revenues. If the euro strengthens against the US dollar, your euro equivalent revenues decreases. That's FX risk. Finally, there are commodity risk, price volatility in commodities like oil, gold, silver, or agricultural products. This affects not just commodity traders, but also companies that use these inputs. An airline traces huge commodity risk from fuel prices. A food manufacturer bears commodity risk from wheat or corn prices. Market risk is typically measured using value at risk VAR and stress testing methodologies, which we will discuss in details later. These tools help institutions understand their potential losses under various market scenarios. Moving to our second major financial risk, credit risk. Credit risk is the risk that a counterparty will fail to meet their contractual obligations. In simple terms, it is the risk that someone who owes you money won't pay you back. Credit risk comes in two main types. Bankruptcy risk represents complete default. The borrower cannot and will not repay. This is extreme scenario. Think of Lehman Brothers, for example, defaulting in 2008, or more recently, companies going bankrupt during the pandemic. When bankruptcy occurs, lenders typically recover only a fraction of what they are owed, if anything at all. Downgrade risk involves credit quality deterioration without actual default. The borrower's financial condition weakens, their credit rating gets downgraded, say from BBB to BB, but they continue making payment. Why does this matter? Because if you're holding a bond that gets downgraded, its market value falls immediately. You haven't lost yet your money yet, but your possession has lost value, and the probability of eventual default has increased significantly. Let me give you a practical example. Suppose you lend $1 million to a company rated A. If they get downgraded to BBB, your loan is now riskier. If you try to sell it, you will get less than $1 million because buyers demand a higher yield to compensate for increased risk. That loss is credit risk manifesting in downgrade risk. Credit risk is measured through metrics like probability of default, PD, loss given default, LGD, and exposure at default, EAD, concepts that we will explore more deeply when we get to the expected loss section. Now, let's talk about liquidity risk, a risk that is often underestimated but can be absolutely fatal to financial institutions. We saw this clearly during the 2008 financial crisis when several major institutions failed primarily due to liquidity problems, not insolvency. Liquidity risk has two main dimensions. Funding liquidity risk is the inability to meet cash obligations when they come due. Imagine a bank that can't meet deposit withdrawals or cannot roll over its short-term funding. This can quickly spiral into a crisis. Even if the institution is technically solvent, meaning assets exceeds liability, if it cannot access cash right now, it fails. This is what happened to Northern Rock in the UK in 2007. The bank was solvent but couldn't finance its short-term borrowing, leading to the first bank run in Britain in over a century. Market liquidity risk means you cannot exit positions at fair prices without significantly impacting the market. In normal times, you can sell a bond or stock close to its quoted price, but in stress market, bid-ask spreads widen dramatically, buyers disappear, and what was once a liquid asset becomes illiquid. You might have to sell at a steep discount, crystallizing losses. A common source of liquidity risk is asset-liability mismatch or timing gaps in cash flows. The classic example is maturity transformation in banking, funding long-term assets like 30-year mortgages with short-term liabilities like overnight deposits or commercial paper. This works fine in normal time, but when you cannot refinance that short-term funding, you have a real problem. Here is the key insight. Liquidity risks become critical during financial crises and market stress periods. Many institutions that failed during 2008 didn't fail because they were insolvent, they failed because they ran out of liquidity. Lehman Brothers is the prime example. This is why stress testing and liquidity coverage ratios like the LCR and NSFR are now central to banking regulations under Basel III. We will discuss these concepts later. Now, let's move to non-financial risks, starting with operational risk. This has become increasingly important, especially with the rise of technology and cyber threats. Operational risk is defined as the risk of loss from inadequate or failed internal processes, people, systems, or from external events. Unlike markets or credit risk where you take risk to earn returns, operational risk generates no return. It's pure downside. Let me highlight three major sources. Internal fraud that involves employee misconduct, things like unauthorized trading, theft, or manipulation of records. The classic example is Nick Leeson, the rogue trader who brought down Barings Bank in 1995 through unauthorized futures trading, resulting in losses exceeding £800 million. More recently, we had the London Whale incident at JP Morgan in 2012, where unauthorized derivative positions led to over $6 billion in losses. External fraud includes cybercrime, hacking, theft, and increasingly ransomware attacks. Financial institutions are prime targets for cyber criminals because that is where the money is. In 2016, hackers stole $81 million from Bangladesh Bank using fraudulent SWIFT messages. These attacks are becoming more sophisticated every year. System failures cover IT and technology breakdown. In today's digital banking environment, a system outage can halt operations completely and damage customer trust. Remember the TSB IT disaster in 2018. Their system migration went wrong, locking 1.9 million customers out of their accounts for weeks. The direct cost exceeded £313 million, not counting reputational risk or reputational damage. Here is the challenge. Unlike market or credit risk, operational risk is harder to predict and model because it's often involves human behavior, technology failures, and unexpected events. You cannot easily put a probability distribution on the next cyber attack or rogue trader. Let's break down operational risk further into its four main sources. Understanding this taxonomy is important for the exam. Process risk arises from flawed procedures and workflows. Maybe your reconciliation process has gaps that allow errors to go undetected. Perhaps approval procedures are improperly designed, enabling a junior employee to execute large trades without proper oversight. These process weaknesses create vulnerabilities. A good example is inadequate segregation of duties. If the same person who executes trades also confirms them, you are inviting trouble. People risk encompasses human error, incompetence, or inadequate training. When even with perfect process, people make mistakes. Someone enters a trade for $1 billion instead of $1 million. That is a so-called fat finger error. The risk increases when staff are poorly trained, when there is high turnover, or when there is inadequate supervision. You also have people risk from deliberate misconducts like fraud or unauthorized activities. Technology risk includes system outages, software bugs, and cyber attacks. As financial services become more digital, this risk grows exponentially. We are dependent on technology for everything: trading, payments, clearing, settlement, customer service, and so on. When systems fail, everything stops, and cyber risk is now recognized as a major systemic threat. A coordinated attack on payment systems could paralyze the financial system. Finally, external events are things largely outside our control: natural disasters, terrorism, pandemics, geopolitical shifts, or sudden regulatory changes. While we cannot prevent these events, we can en masse plan for business continuity. The COVID-19 pandemic tested everyone's business continuity plans. Firms that had invested in remote working capabilities adapted quickly. Others struggled. The Basel Committee has identified 7 categories of operational risk events, and banks are required to hold regulatory capital against operational risk exposures. These become mandatory under Basel II and continues under Basel III. Legal incompliance risk has become increasingly prominent since the 2008 crisis, with regulators imposing billions in penalties for violations. Regulatory risk involves violations of laws and regulations. Financial services is one of the most heavily regulated industries globally. You have prudential regulations, conduct regulations, anti-money laundering rules, data protection laws, the list goes on. Violations can result in massive fines, restrictions on operations, or even criminal prosecutions of executives. Look at Wells Fargo's fake account scandal. Over $3 billion in penalties, plus immeasurable reputational damage. Or consider the LIBOR manipulation cases. Major banks paid over $9 billion in fines collectively. Legal risk covers lawsuits, litigations, and contractual disputes. This could be customers suing over missold products, counterparties disputing contract sums, or employment-related litigation. In derivatives markets, legal risk includes the risk that a contract might not be enforceable in court. During the 2008 crisis, there were countless lawsuits over mortgage-backed securities, investors claiming they were misled about the quality of underlying loans. Compliance risk is about non-adherence to internal policies and procedures, even when they go beyond regulatory requirements. Many institutions have policies stricter than regulators require, and violations still create risk. For example, your bank might have internal limits on concentration risk that are tighter than regulatory requirements. Breaching those limits creates compliance risk. Here is an important point. Legal incompliance failures often lead to reputational damage from regulatory actions. When a regulator publicly fines your institution over $100 million for AML failures, the direct cost is that $100 million. But the indirect costs, lost customers, increased regulatory scrutiny, difficulty attracting talent, higher funding costs often exceed the direct fine many times over. The market punishes trust violations severely. Strategic risk arises from poor business decisions or changing market conditions that affect the long-term viability of the organization. This is different from other risks we have discussed because it's more about fundamental business direction. Competition risk involves market share erosion. New entrants, especially fintech companies, are disrupting traditional banking models with better technology, lower costs, and superior customer experience. If you don't adapt, you'll lose customers and revenue. Think about how digital-only banks like Revolt or N26 have captured younger customers who find traditional banking cumbersome. If established banks don't respond effectively, they face strategic risks of obsolescence. Technology disruptions represent innovation threats. Think about how mobile payments, blockchain technology, and cryptocurrencies are challenging traditional payment systems, or how robo-advisors are disrupting wealth management, or how peer-to-peer lending platforms bypass traditional bank intermediation. Institutions that fail to innovate risk being left behind. Blockbuster versus Netflix is the classic example. Different industry, but the lesson applies. Business model risk is about your fundamental approach becoming outdated. The business model that worked for decades may not work in the digital age or in the AI age. Kodak had the technology for digital photography but failed to adapt their business model. And banking institutions that relied heavily on branch networks and manual processes faced business models risk as customers moved to digital channels. Strategic risk is often the hardest to manage because it requires forward-looking vision, not just analysis of historical data. You cannot use VAR to measure strategic risk. It's managed through strategic planning, market intelligence, innovation, and willingness to transform. And it requires leadership that can see around corners and make bold decisions. Reputational risk is the risk of damage to brand image and public perception. And financial services, trust is everything. Without trust, customers leave, counterparties demand higher margins, and funding costs increase. Reputational risk manifests as loss of customer trust and confidence. Once customers lose faith in an institution, they take their business elsewhere. In the digital age, negative news spreads instantly through social media. A single incident can go viral within hours, causing damage that takes years to repair. Here is a crucial insight that is important for the exam. Reputational risk is often a consequence of other risk types. It's a secondary risk that amplifies primary risks. A major operational failure, like a data breach exposing customer information, triggers reputational damage. A compliance violation, like discriminatory lending practices, leads to reputational harm. A credit crisis, like excessive subprime mortgage exposure, destroys reputation. The consequences can be severe: deposits runs in banks, client departures in asset management, or inability to attract talent. During the 2008 crisis, Bear Stearns and Lehman Brothers experienced rapid loss of confidence. Once market participants doubt your viability, counterparties refuse to transact, lenders withdraw funding, and you spiral into failure. Reputational risk is particularly dangerous because recovery is slow and difficult. You can lose your reputation overnight, but it takes years, sometimes decades, to rebuild. This is why institutions invest heavily in corporate communications, crisis management plans, and stakeholder relationships. Prevention is far better than cure when it comes to reputation. Consider the Volkswagen emission scandal. Billions in fines were the direct cost, but the reputational damage to the German engineering quality brand was incalculable and continues years later. Model risk has become increasingly important as financial institutions rely heavily on quantitative models for pricing, risk measurement, and decision making. Model risk arises from several sources. First, incorrect model design or assumptions. Your model might be based on assumptions that don't hold in reality, or it might not capture important risk factors. For example, many pre-2008 models assumed that housing prices across different US regions were not highly correlated. That assumptions proved catastrophically wrong when the housing market collapsed nationwide. Second, improper use of models for pricing and risk assessment. A model might be appropriate for one purpose but misapplied to another, or users might not understand the model's limitations. VAR models, for instance, are designed for normal market conditions. Using them to measure risk during a crisis, when correlations break down and markets become illiquid, gives misleading results. Third, data quality issues and parameter errors. Remember the principle garbage in, garbage out. If your input data is flawed, outdated, or incomplete, your model outputs will be wrong. Similarly, if parameters are incorrectly calibrated, say you are using historical volatility from a call period to price options, your valuation will be off. Finally, failure to validate and update models. Markets evolve, relationships change, regulations shift, and models need regular validation and recalibration. A model that worked well in 2016 might not work in 2026. Yet, many institutions keep using old models without proper backtesting or validation. The 2008 financial crisis highlighted model risk dramatically. Money risk models, particularly those for structured credit products like CDOs, failed spectacularly. They didn't capture tail risks. They underestimated correlations during stress, and they relied on limited historical data. This led to regulatory focus on model risk governance, independent model validation, and stress testing that goes beyond model outputs. For the exam, understand that model risk is real. It can be substantial, and it requires robust governance and validation frameworks. This slide introduces an important concept, wrong way risk, illustrated throughout the commercial real estate cycle. Commercial real estate demonstrates extreme loss variability. CRE lending shows boom-bust cycles where losses cluster in bad years. During economic expansions, property values rise, tenants pay rents reliably, and defaults are rare. But when recession hits, the dynamics reverse dramatically. Here is the wrong way risk dynamic. The probability of default rises as collateral values fall. When a borrower defaults on CRE loan, you seize the property as collateral. But if defaults are happening because property values have crashed, your collateral is worth much less than you expected. You face high default probability precisely when recovery values are lowest. That is wrong way because both factors move against you simultaneously. This creates a pattern where risk factors act together to produce waves of extreme loss. You see long runs of years, good years with minimal losses, then suddenly devastating losses concentrated in short periods. The distribution is not normal. It has fat tails and negative skewness. This is a classic example of correlation risks and tail risk. During good times, everything looks fine, risk models suggest low losses, and lenders become complacent. Then a shock hits and suddenly you have widespread defaults combined with collapsed collateral values. This pattern isn't limited to CRE, it applies to many credit portfolios. The key lesson for risk manager is that averaging historical losses can be deeply misleading. You need to understand the drivers of loss, clustering, and stress tests for scenarios where multiple factors move adversely together. This is a critical concept for both the exam and real-world risk management. Risks rarely occur in isolation. They are interconnected and can amplify each other in dangerous ways. Consider this example. Market stress triggers liquidity problems. When market volatility spikes, say due to geopolitical tensions, margin calls increase sharply. If you are running a leveraged portfolio, you suddenly need to post more collateral. At the same time, funding sources dry up as lenders become more risk averse. What started as market risk quickly becomes a liquidity crisis. This is exactly what happened to the long-term capital management in 1998. Another connection. Credit losses lead to reputational damage. When a bank announces significant loan losses, say they have large exposures to a failing sector, depositors start worrying about the bank's safety. If concern spreads, you get deposit withdrawals, creating liquidity stress. The credit risk event triggers both reputational and liquidity risks. We saw this with the Silicon Valley banks in 2023. Similarly, operational failures cause compliance violations. Imagine a system failure that prevents you from submitting regulatory reports on time. The operational issues becomes a compliance problem, resulting in regulatory penalties. Or consider a data breach. It's an operational failure, but it triggers legal liability, regulatory sanctions, and massive reputational damage. This interconnection is why we need enterprise risk management (ERM), not siloed approaches where each department manages risks independently. Risk limits must consider correlations between risk types. Stress tests must model multiple risks simultaneously, not in isolation. The cascading nature of risk means that seemingly small issues can spiral into major crises if not managed proactively. This is sometimes called the doom loop, where one risk triggers another, which feeds back to amplify the first. Risk management must account for these feedback loops and contagion effects. Now, let's talk about the risk management process, the systematic approach to handling risks. This is a four-step cycle. Step 1, identify risks. You need to know what risks you face. This involves analyzing your business activities, understanding potential threats, and recognizing emerging risks. Step 2, measure risks. Once identified, you quantify the risks using appropriate metrics. VAR for market risk, expected EL or UL for credit risk, key RI or key risk indicators for operational risk. Step 3, evaluate risks. You assess whether your risk exposures are acceptable given your risk appetite and compare them against limits. Step 4, manage risks. You decide how to respond, avoid, retain, mitigate, or transfer the risk. Then the cycle repeats. Risk management is continuous, not a one-time exercise. Markets change, new products are launched, regulations evolve, so you constantly circle back to identification. This process should be embedded in your organization's governance with clear roles and responsibilities, reporting lines, and escalation procedures. Effective risk management isn't just about having sophisticated models, it is about having robust processes that ensure risks are identified early and addressed appropriately. Let's explore the method for risk identification, which is the crucial first step. Brainstorming sessions bring together people from different areas, front office, risk, compliance, operations, and back office to identify potential risks. Diverse perspectives help surface risks that might be missed by a single department. Industry service and benchmarking involves looking at what risks other institutions face and what loss events have occurred in the industry. If a peer experienced a cyber attack, you should assess whether you have similar vulnerabilities. Expert opinions and consultations leverage specialist knowledge. This could be internal experts or external consultants who have deep expertise in specific risk areas. Regulatory standards and guidelines provide frameworks for risk identification. Basel regulations, for instance, define categories of operational risks. These standards reflect accumulated industry experience. Scenario analysis involves imagining what-if situations. What if interest rates rise 200 basis points? What if a major counterparty defaults? What if there is a pandemic? This forward-looking approach helps identify risks that haven't materialized yet, but could. The key is to be systematic and comprehensive. Missing a risk at the identification stage means you won't measure or manage it. And that is how institutions get blindsided. This slide presents a useful framework for thinking about risks, the risk spectrum of known knowns, known unknowns, and unknown unknowns. This framework was popularized by former US Defense Secretary Donald Rumsfeld, but it applies perfectly to risk management. Known knowns are risks we are aware of and understand. We know they exist, we can measure them, and we have tools to manage them. Market risks and credit risks generally fall into this category. We have decades of data, sophisticated models, and proven management techniques. Known unknowns are risks we know exist but can't fully measure. We are aware of them, but quantification is difficult. Operational risk often fits here. We knew cyber attacks happen, but precisely predicting when and how is impossible. We knew model risks exist, but measuring it is challenging because models are used to measure other risks. Unknown unknowns are risks we are completely unaware of. These are the true black swans, events we didn't even conceive of as possible. These are the most dangerous because by definition we haven't prepared for them. The challenge is that the most devastating events often come from the unknown unknown category. Since we can't identify or measure them, we rely on building general resilience, capital buffers, liquidity reserves, diversification, stress testing with severe scenarios, and crisis management capabilities. For the exam, understand this framework and recognize that different risk management approaches are needed for each category. Known risks can be managed with quantitative tools. Unknown risks require qualitative judgment, scenario planning, and robust governance. Let's look at some real-world examples of unknown unknowns that became all too real. The 2007-2009 financial crisis stemmed from systemic risk related to subprime mortgages. Before it happened, few imagined that problems in one segment of the US housing markets could trigger a global financial meltdown. The interconnections through securitization, the extent of leverage, the correlation of defaults, these were not properly understood or modeled. It was an unknown unknown that became catastrophic. The COVID-19 pandemic represents another unknown unknown. While epidemiologists had warned about pandemic risk, the specific timing, nature, and economic impact of COVID-19 weren't predicted. It forced entire economies into lockdown, disrupted global supply chains, and created market volatility that exceeded historical patterns. Very few firms had stress scenarios contemplating simultaneous demand shocks, supply shocks, and forced closure across all sectors. Geopolitical shocks like unexpected conflicts and disruptions represent another category. These events have far-reaching economic consequences through energy prices, trade disruptions, financial sanctions, and market uncertainty. The lesson from this example is humility. No matter how sophisticated our models, we cannot predict everything. This is why we need robust capital buffers that can absorb unexpected losses, diversification to avoid catastrophic concentration, stress testing with extreme scenarios beyond historical experience, crisis management plans that can be activated quickly, a culture that questions assumptions and challenges models. As the British statistician George Box said, all models are wrong, but some are useful. We must use models while acknowledging their limitations. Now let's dive into the most widely used quantitative risk measure, value at risk or VAR. VAR is defined as the maximum expected loss for a given confidence level over a specific time period. Let me break that down because the definition is crucial. VAR equals the quantile of the loss distribution. If you map out all possible losses and their probabilities, VAR is the loss threshold that will not be exceeded with a certain probability. The common confidence levels used are 95% and 99%. At 95% confidence, we are saying that there is only a 5% chance losses will exceed this threshold. Here is the key question VAR answers. How bad can losses get in X% of cases? Or putting it differently, what is the worst loss I can expect on a normal day? VAR is typically calculated for specific holding periods, 1 day for trading books, longer periods for investment portfolios. A one-day 99% war of $10 million means on 99% of days our losses will not exceed 10 million. But on 1% of day, roughly 2 or 3 days per year, losses could exceed this amount. It's important to understand that what war tells you and critically what it doesn't tell you. War gives you a threshold, but it does not tell you how bad losses might be on that worst 1% of days. You could lose $11 million or $100 million. War doesn't distinguish. That's where expected shortfall, which we will discuss shortly, becomes important. Let's explore war more deeply with a formal definition. Worst expected loss over a given horizon under a normal market condition at a given level of confidence. Notice the phrase under normal market conditions. This is a critical limitation. War is designed for typical market circumstances, not crisis scenarios. Here is a practical example. Weekly war at 95% confidence of 10 million means there is a 5% chance, 1 week in 20, of exceeding 10 million in losses. Or stated positively, we are 95% confident that losses will not exceed 10 million in any given week. VAR uses the loss distribution to estimate losses at the specified confidence level. You can think of it as finding the 5th percentile for 95% confidence or 1st percentile for 99% confidence of the loss distribution. VAR is developed by JP Morgan in 1990s as part of their risk matrix system and quickly became the industry standard. Regulators like it because it is a single number that summarizes risk across different positions and asset classes, and management likes it because it is intuitive, easier to understand than statistical concepts like standard deviation. However, VAR has important limitations. It says nothing about the magnitude of losses beyond the threshold. It can underestimate tail risk. Different calculation methods, for example, parametric, historical, Monte Carlo, can give different results. It assumes historical patterns will continue. Despite these limitations, VAR remains the most widely used risk measure in financial institutions and is embedded in regulatory capital frameworks. Let's work through a VAR calculation examples to make this concrete. Given an investment of $1 million, the worst 5% return is minus 15.5%, confidence level 95%. The VAR will be 1 million times 15.5% is equal to 155,000. What does it mean? We are 95% confident that losses will not exceed 155,000. Alternatively, there is only a 5% probability, roughly 1 time in 20, that losses will exceed 155,000. Let's make sure we understand what this means practically. If you are a risk manager reporting to senior management, you are saying, under normal market conditions, our worst loss should be 155,000 or less on 95% of occasions. But on 5% of occasions, the really bad days, we could lose more than 155,000. This is why VAR is often supplemented with stress testing. VAR tells you about normal bad days. Stress tests tell you about crisis scenarios that fall in that tail beyond VAR. For the exam, be comfortable with VAR calculations and interpretations. You might get questions asking you to calculate VAR given returns data or to interpret what a specific VAR figure means. Expected shortfall, or ES, addresses one of the VAR's key limitations. It is also called conditional VAR or CVAR. ES is defined as the average loss beyond the VAR threshold, while VAR asks how bad can it get 95% or 99% of times. ES takes if we exceed VAR, if we are in that tail, what is the average loss we face? The alternative name, conditional VAR, reflects this. It is the expected loss conditional on exceeding the VAR threshold. If loss goes beyond VAR, how much will that loss be on average? Here is the key advantage. ES captures extreme tail losses better than VAR. VAR just gives you a threshold. ES tells you about the magnitude of losses and the tail. This makes ES more informative for understanding extreme risk. Let me give you an example. Suppose your 99% VAR is 10 million. That means on 1% of days you will lose more than 10 million. But how much more? Your AS might be 15 million, meaning that on those rare bad days when you breach VAR, your average loss is 15 million. From a risk management perspective, ES is superior to VAR because it is a coherent risk measure. It satisfies mathematical properties that VAR doesn't. Specifically, E is sub-additive. The risk of combined portfolio is less than or equal to the sum of individual risks, while VAR is not necessarily sub-additive. We will explore these concepts later. This is why Basel regulations have moved toward incorporating ES into capital requirements. The Basel Committee recognizes that ES provides a more complete picture of tail risk than VAR alone. Let's directly compare VAR and expected shortfall to understand their differences. First, VAR. It represents a loss threshold at the confidence level. It is the boundary point, that is, losses will not exceed this value X% of the time. Second, VAR doesn't capture tail severity. It tells you nothing about how bad losses might be beyond the threshold. You could have two portfolios with identical VAR but vastly different tail risks. VAR is not a coherent risk measure. Mathematically, it can violate sub-additivity, meaning diversification might appear to increase risk, which is counterintuitive. And second, we discuss the expected shortfalls. It represents the average of tail losses. It looks beyond the threshold and averages all the losses in that tail region. ES captures extreme losses. It incorporates information about the severity of tail events and not just the frequency of them. And also, ES is a coherent risk measure. It satisfies all four properties of coherence, like monotonicity, sub-additivity, positive homogeneity, and translation invariance. We will discuss these concepts later. For risk management purposes, E is theoretically superior to VAR because it provides more complete information about extreme risks. This is particularly important for portfolios with fat tail distributions or significant tail dependencies. However, VAR remains widely used because it is simpler to calculate and explain. It is embedded in regulatory frameworks, though this is changing. It's become the industry standard over decades. And for the FRM exam, you should understand both measures, their calculation, interpretation, and relative advantages. You should be able to explain why ES is considered superior from a theoretical point of view and why regulators are increasingly focusing on ES rather than just VAR. Now let's turn to credit risk measurement, starting with expected loss or EL. Expected loss represents normal anticipated business loss. When you make loans, you expect some borrowers to default. It is cost of doing business, like salaries or rent. You price for it by charging interest that includes a credit spread to cover expected losses and many other things. The formula for expected loss is EL equal to PD times EAD times LGD. Let me break down each component. PD is probability of default. What is the probability that a specific borrower will default over the time horizon? This is typically estimated using credit ratings, historical default rates, or internal scorecards. For example, a B-rated corporate borrowers might have a 5% probability of defaulting in the next year. EAD is exposure at default. What is the outstanding loan amount or exposure when default occurs? For a term loan, this is straightforward. It is the principal balance. For a revolving facility like a credit line, it is more complex because borrowers might draw down the facility before defaulting. LGD is loss given default. If the borrower defaults, what percentage of exposure do you lose? This depends on recovery rates, which depends on collateral, seniority, bankruptcy procedures, and so on and so forth. If you recover 60%, your LGD is 40%. Expected loss represents the average loss over time. If you make thousands of similar loans, your actual losses should converge to the expected loss. This is why EL is covered by loan loss provisions and pricing. It is a predictable cost. For the exam, be much comfortable with this formula and each components of this formula. You will be likely get calculation questions involving EL and even unexpected loss that will be coming in the next slide. Let's work through an expected loss calculation example. Given PD 2%, EAD 1 million, LGD 40%, which in this case the recovery rate is 60%, we calculate the expected loss or EL as following. EL is equal to PD times EAD times LGD. EL is equal to, in this example, 0.02 times 1 million times 0.4, and that gives an expected loss of 8,000. What does it mean? On this 1 million loan, we expect to lose 8,000 on average. Notice that is small percentage, less than 1%, but it is not zero. Here, how this works in practice. If you make 100 identical loans like this, you expect about 2 loans to default. That is 2% PD. On those 2 loans totaling 2 million in an exposure, you will lose 40% of that, which is $800,000. Spread across all 100 loans, that is 8,000 per loan on average. As a lender, you need to price your loan to cover your funding costs, operating expenses, expected loss of 8,000 in this case, a return on capital for unexpected losses, your target profit margins, and all these things. The credit spread you charge must at minimum cover the expected loss. If you are charging less than say 0.8% spread on this loan, which generates $8,000 on 1 million, you are underpricing and will lose money over time. This is fundamental to credit risk management. EL is a cost that must be priced into products. Unexpected loss, or UL, which will be discussed next, requires capital. Now let's move to unexpected loss, or UL. While expected loss represents the average, unexpected loss represents deviation from that average. It is the volatility or uncertainty around expected loss. Think of it this way. If I flip a fair coin 100 times, I expect 50 hits, but I might get 45 hits or 55 hits. That variation is like unexpected loss. In credit portfolios, some years you will have fewer defaults than expected, other years more. UL measures this variability. Mathematically, UL is the standard deviation of losses around the expected loss. It is calculated using the variance of the default process, correlation between obligors, and variation in recovery rates. Here is the critical distinction. Expected losses covered by provisions and pricing, and unexpected losses covered by economic capital. Economic capital is the capital buffer you need to absorb unexpected losses and remain solvent. If you only held capital equal to EL, you will be insolvent 50% of the time whenever losses exceed the average. You need capital to cover EL plus several standard deviations of UL to ensure solvency with high confidence. Typical institutions set capital to cover sometimes like EL plus 3 times UL, ensuring they can absorb losses in all but most extreme scenarios, roughly 99.9% confidence. For the exam, understand the distinction. EL is expected and priced. UL is unexpected and requires capital. This is fundamental to Basel capital framework. You should also consider this example as we had for expected losses, and that shows that we have 56,000 unexpected losses for this specific example, and you can try this by yourself using the formula given. This slide illustrates correlation risk, which is critical to understanding why unexpected loss can be so much larger than expected loss. Here is the scenario. An economic downturn occurs, leads to multiple borrowers default simultaneously. As a result, losses become correlated and unexpected losses increase dramatically. Let me explain why this matters. If defaults were independent, meaning one borrower's default does not affect others, unexpected loss would be relatively small due to diversification. In a portfolio of 1,000 loans, some borrowers default, others don't, and it averages out. But defaults are not independent. When the economy enters recession, unemployment rises, affecting money consumer borrowers simultaneously. Industry sectors struggle together, affecting multiple corporate borrowers. Real estate values fall, reducing collateral values across portfolios. And credit availability tightens, making refinancing difficult for many borrowers. This is correlation risk. The risk that seemingly diverse exposures are actually correlated through common factors. When the common factors, such as the economy, deteriorates, losses spike across the portfolio. This correlation dramatically increases unexpected loss. The variance of portfolio losses depends on individual loan variances, but